I will make the comment that the smart money and the institutional investors are watching for the enthusiasm, greed, and delusion and denial of the public, and the smart money and institutional investors, they'll be selling at the point of delusion and denial, and comments about things returning to normal. When it has that little blip up. Now that would be um, in late 2011. There's been some recovery from 2009 to 2011. There's been some recovery in stock prices in the U.S. as well as U.K. and so on. Even fuel prices came down. They came back up. They could go back down again. It's not that in 2004 I said fuel prices are going to go up to $11 per gallon immediately in the U.S. Or in Venezuela. That wasn't the forecast. The forecast was they're going to go up enough. Fuel prices are going to go up enough that it's going to affect the economies of the U.S. just like it's been affecting the economy of UK and Japan and many other places. I didn't say Saudi Arabia or Venezuela is going to have an economic contraction, or even Alaska. Places that produce oil may do quite well, at least for quite a while. So if fuel prices rise faster than other prices, that still fits my forecast. If fuel prices fall but fall slower than other prices, that still fits my forecast. My point was that fuel prices are going to do better than most other commodities, most other consumer prices, and so on. When I say do better, I mean rise faster or fall slower overall than other stuff. And that will lead to shifts in the economies of places like Canada, which haven't been affected so much as the U.S. has, or the U.K. has, or as Japan has. Canada is a net exporter of fuel currently, mostly to the U.S., of course. So back to the content of the blog. People in Saudi Arabia were asking me, when are prices going to be 10 cents again here in Saudi Arabia? They're all the way up to 65 cents per gallon now in 2011. Well, I told them they might not go back down to 10 cents. Naturally, what I told them is that gasoline prices will only recover after people stop driving 50 miles per hour over speed bumps. In other words, after people adapt. That's when gas prices will drop, is after people start using less. That's how that works. So further, U.S. economic growth will not recover to come close to what it was when gasoline prices here were 65 cents per gallon, unless it does. It might not. It hasn't yet. The growth in the U.S. economy peaked at a certain time. The production of oil in the U.S. economy peaked at a certain time. Again, it was the number one producer of oil for most of the 20th century worldwide. The U.S. was. The peak of household wealth relative to total household debt in the U.S., that peaked a long time ago. So now let's look at another global chart. Oil revenue per person in Kuwait, it's around $33,000 per person of profits or revenues from oil exports. In Libya, it's only about 14,000. In Saudi Arabia, about 19,000. In Iraq, it's maybe 5,000. Canada, maybe $4,000 per person. So some countries that are net exporters of oil, like oil producing and exporting countries, OPEC, that's OPEC, oil producing and exporting countries. Well, those countries, the U.S. used to be a country that benefited tremendously from having all that oil in the early 20th century and middle 20th century. The U.S. didn't export a lot of oil really, but it would produce things like steel using local oil and then export the steel and sell that to Europe or wherever, Japan, and did very well in terms of its trade deficit in the U.S. But that has changed. Anyway, it's interesting to note that in Kuwait, according to that chart with the blue lines there, the net trade surplus from oil is over $33,000 per year per person. That is an unusually large transfer of wealth from other nations to that one. Like for an infant who happens to be born in Kuwait, there's a huge inflow of wealth from other nations, mostly places like the U.S. and the U.K. and Japan. There's a huge net flow of wealth from certain places to other places like Kuwait. $33,000 per year per person. You happen to be born there, that's the benefit you get. Now, in the middle of the 20th century in the U.S., again, that net trade um, surplus for the U.S. in 1900, 1920, 1950. I don't mean those specific years, but around those times, in those decades, in that era, the U.S. was doing very well. Now we could look at China and its net imports revenues per person in China, and of course we might think, well, China's doing really, really well as far as their trade surplus with other nations like the U.S. However, China has a lot of people, so the actual net, inflow, net trade revenue. Let's see, the net surplus in trade for China is very large, but per person, not so big a deal. In the U.S., though, in 1950 or 1910, considering all the productivity the U.S. had with all that oil being produced and refined and used here, and then steel and all those other things, missiles and tanks and stuff that we got to benefit from as a nation. Well, all of the infants that happen to be born in the U.S., they got the benefit of that. Now in Kuwait, someone gets $33,000 per year per person there in net transfer of affluence from other places to Kuwait, or in the case of Iraq, from $5,000 per year per person from other places to Iraq. Wow, that's a decent amount of money. Other places have a net deficit, a net trade deficit. They're going into debt. Places like, well, Japan, the U.S., Greece, UK, Spain. Yeah, it's kind of a long list. Most of Europe. All right, so my forecast continues to be that oil-rich nations and oil-rich regions, actually, like Alaska and Alberta, the state and the province in the U.S. and in Canada, those two places, they have a whole lot of oil. So they're going to continue to experience profound economic growth, rather to places like Nevada that don't have much oil production. Saudi Arabia will continue to do well relative to places like the UK or Japan. That's just in relation to their oil, and again, we can make it per capita. But the purchasing of fuel by Japan from places like Arabia, it's a net flow of capital to places like Arabia. So I might be wrong. Oil-rich places like Alaska, Alberta, and Arabia might not get profound economic growth relative to other places that are buying fuels from them. But I think it's predictable that those places will continue to do well. And when I say continue, Alberta's been doing pretty well for quite a while. Alaska's been doing pretty well for quite a while. Not that Alaska's a big economic state, but the growth has been huge because the economy was so small there in 1950 or 60. The growth in Alaska has been immense. Why? They have a lot of oil. That's a big part of it. So the Soviet Union dissolved, even though it was one of the most oil-rich regions of the planet. However, it was not so oil-rich per capita. It was just oil-rich overall. It was a very big geographic area that the Soviet Union covered. So annual oil production in around 1971, was it? I can't really tell from that chart, but it was the early 70s. The former Soviet Union became the #1 producer of oil in the world for from throughout the late 70s into the 80s, and then of course the Soviet Union collapsed around 91, I think it was, and their production of oil, when they had the infrastructure instability of the collapse of the actual, bureaucracy of the Soviet Union itself, well, oil production did drop quite a bit. And now is back up towards those levels. And as you can see from that chart with the blue line, the U.S.'s oil production is down to not quite half of what it was in the peak years of 1970 or 69. So eventually one of my forecasts will probably be wrong, even inevitably. So far, though, there has been a distinctive positive correlation between my forecasts and actual developments. Many other people have made alternative forecasts based on such methodologies as positive thinking and hope for change and irrational exuberance. Like they've said, well, oil prices will be back to $1. Gasoline price will be back to $1 per gallon in the U.S. soon. Well, somebody may have thought, well, that's a very nice thought to have. It's very optimistic. It just may not have been accurate, and it still might not be. Or it might be. So there has been a negative correlation between their declared forecasts of many people and the actual reality that emerged, including for people like in 2005, I extensively ridiculed a publication by Wells Fargo's chief financial analyst through Wells Fargo. It was dismissing the potential for a real estate decline and for a mortgage crisis. It was dismissing the importance of rising fuel prices. If somebody cares, they can contact me. I'll send them a link to it. It's not linked here, but anyway, lots and lots of people have made a lot of very popular forecasts. A lot of people really liked those forecasts. They just were inaccurate, and while some of those forecasts were free, they were very expensive to follow. They cost people their homes, their businesses, foreclosures, bankruptcies, that kind of stuff. So it is important to be aware that my negativity about when oil prices will be $11 again or when gas prices will be 65 cents again in the U.S., that so-called negativity, that's also maybe practicality. That's what it is. It's the fact is gasoline prices are not 65 cents per gallon. They might not be ever again in the U.S. Now, I have a few more questions for you. If a person pays, if a person has $50,000 of cash and then they make a new promise to pay $500,000 on a mortgage, then how much additional cash do they have after making the new promise and spending $5,000 as a down payment on their real estate speculation? Did you notice that the question itself, as far as how much additional cash do they have after spending some money, that question actually reveals a lack of comprehension of the subject matter. You don't get more cash by giving cash out to spend it for something, right? There's no additional cash that they would have. There's no additional cash created. Next, if an insurance company has $50 million and then they make new promises to pay up to $500 million in policy claims, like if somebody's house has a water damage or a life insurance policy or a health insurance policy or a mortgage insurance policy for defaulting on a mortgage. If an insurance company has $50 million and they make new promises to pay $500 million in policy claims, then how much additional cash do they have after making all those new promises and spending $5 million in paying out prior debts? Again, did you notice that the question itself reveals a lack of comprehension of the subject matter? You don't have more cash by spending cash. So now let's look at AIG's stock chart briefly. That was, I believe, the biggest. I think it was the biggest insurance company in the world, not just the biggest in the U.S. Around 2007, things started to go poorly for AIG. Now that was right around the same time as some other things like oil prices going up to 100 into the 140s globally, and when the gas prices really spiked up in places like the U.S. and the U.K. I think it might have even broken $1 per gallon in Saudi Arabia at that time. I actually don't know. I'm just saying that for contrast. So if a bunch of naive stock market speculators pour millions of dollars into trading the stocks of various companies such as AIG, pictured above, how much does that increase the profitability of those companies? All they've done is buy it, like buying a house. Does buying a house really change the actual functional utility of it? Does it make the house more valuable to buy it for more? You haven't, improved the roof. You just bought the house for a higher price. Does that make the house more valuable? No. So does buying stocks of AIG make the company more profitable? No, not at all. In fact, driving up prices like that means that the price per earnings ratio and the dividends of the company drop relative to the price. As the price goes up and the company's no more profitable than it was, that's just speculation in the price of the stock of that company, or the speculation in the price of um, real estate. It's like paying $3 a gallon instead of $2 a gallon doesn't add more to the amount of fuel in a gallon. A gallon is still a gallon. So all those people putting all that money into AIG back in the 90s, that didn't necessarily increase the profitability of the company. They were just trading shares of the company. That didn't, it wasn't spending money on a roof to make AIG's, building have a better roof or whatever. That was just they were just speculating on the value of the AIG stock. So how much does it increase the net profits of the companies when investors buy and sell stocks of the company? It doesn't. No effect on the net profits of the company with buying and selling stocks. The net, the actual structural value of a house when someone buys or sells that house, no change. The roof's still the same roof. Similarly, when investors buy and sell stocks of other companies besides AIG, driving up those share prices, does that really have any lasting effect on the tangible book value of other companies who also owns shares of, for instance, Enron or AIG or Fannie Mae? How do fluctuations in the market pricing of the stocks for a company filing bankruptcy affect the debt to asset ratio of the company, their solvency? The stock prices don't affect the bankruptcy, the debt to asset ratio of the company. It doesn't make the company more valuable when stock prices fall. It doesn't make the company less valuable. The stock prices of the company reflect people's perceptions and people's willingness to spend money and that kind of stuff. But it doesn't affect the profitability or the solvency or the finances of the company internally. It doesn't increase Walmart's revenues to buy stocks of Walmart. If you want to increase Walmart's revenues, you have to go to Walmart and spend money there. So to compute the book value of one thing off of the market pricing and recent comps or compatible similar priced things, to compute the book value of one thing off of the market pricing and recent comps of another thing is one method of computing a book value figure. It's standard. However, to do so reflects some fundamental presumptions about prices and the stability of prices, and in particular, the risk of the sudden deflating of credit bubbles, as in bubbles of legally valid promises for future performance, which may or may not actually occur in the future as promised. These are account receivables, invoices, accrual debts, if people know that accounting term. It's just promises for future performance. It's like if I get a rental agreement from an apartment complex and I say, for the next 12 months, I'm going to pay you this much money per month. No new money was created. I just have a new promise out there. They write down in their books, this person has promised us $800, and if I don't pay them that, they might try and collect it. Naturally, they would try and collect it from me because I've legally entered into an obligation to pay them that money, even though I don't have it necessarily yet. I just have an obligation to pay it legally. So I assert that most people are not related realistically to the reality of prices or the reality of speculative bubbles of credit promises. For instance, they may not be related to the reality of how gasoline prices vary from place to place and from time to time. They may even call such variations in pricing unpredictable or incomprehensible or horrible or negative or unfair. Why is it only 10 cents a gallon in Venezuela and 65 cents a gallon here in Saudi Arabia? It's just unfair. Yes, it is unfair. It's different. Why is it $4 a gallon in the U.S. and only $3 a gallon in Mexico and $7 a gallon in Japan and $11 a gallon in the UK? That because there's differences in supply and demand in different places, and different taxes. There's there's all the factors that are there, right? So there's a chart from Bloomberg or Conference Board. The chart is really about the Consumer Confident Present Situations Index, the green line, but it shows it in contrast to the S&P 500 stock market index for the top 500 U.S. stocks, or the biggest 500 U.S. companies, and their stock prices. The point is, if you see the red thing at the bottom right of the chart, there's a huge gap. Consumer confidence didn't rise up much from 2009, even though stock prices rebounded quite a bit. across 2009 as well as 2010. Stock prices rebound. Consumer confidence didn't really go up much. So, in fact, another thing to note there is that in the 2007 area, when stock prices made a new high in the U.S., consumer confidence didn't make a new high. So many people may not be related to a realistic future cash value of their insurance policies or their real estate or their stocks. They may be surprised by future variations in pricing. Now, accountants may know the term tangible book value per share, but most people would have never heard of that probably. That is a computation of the value of a business based in large part on current assessed value of current assets. Some companies may have a negative book value, such as insurance companies who regularly make promises far in excess of their current capacity to pay. So there's positive and negative book values are possible. It's a current assessed value of current assets. And those assets of those companies include things like real estate and stocks of other companies within the U.S. or wherever they may be. In the case of an insurance company, they're counting on people, or let's put it this way, in the case of an apartment complex, they're counting on a certain frequency, a certain rate of people actually keeping their promises. They know sometime, eventually, somebody's not going to keep their promise, but most people, most of the time, keep most of their promises as far as paying their rent on a 12-month, rental contract or something. Most people pay most of the time on time and so forth on most of their promises most of the time. But there can be shifts where an entire region or an entire nation or just in a single industry maybe there can be changes in how frequently people keep their promises or how frequently companies or governments keep their promises. So people who have bonds where they lent money to the government of Greece, more recently, in the last few years, people started to be concerned, is the government of Greece going to be able to repay those as promised? Maybe, maybe not. So, tangible book values can be positive, they can be negative. They're based on the current assessed value of current assets. Now, assessments are just assessments. They're just, market pricing figures from wherever they're from. So those computations are based on current assessments, including current assessed value of their stock holdings in other companies and current assessed value of their real estate holdings, which can change quickly, right? So that's a problem. Book values are being computed based on other assessed values of current market pricing, not on other book values. Accountants may also recognize other ratios such as price to book value. That means a ratio of the difference between the market pricing or assessed value and the book value, which is computed off of other market pricing or assessed values, from other assets. Again, do you notice the irony in this? It's a bubble. It's just it's like a house of cards. It's all stacked up. It's all the solvency and the finances of a lot of these places like Lehman Brothers and Fannie Mae. Well, that was dependent on, in the case of Fannie Mae, they were dependent on all these people keeping their mortgage promises. When a bunch of people didn't keep their mortgage promises to Fannie Mae, it produced a really sudden reassessment of the actual value of Fannie Mae's mortgages, of the contracts that they had, where all these people were legally, obligated to pay the money, but that legal obligation did not itself necessarily result in actual payment. So, how much additional cash does an insurance company have after making new promises totaling $500 million in debt? They might not have any new cash based on taking on those new debts, those new promises. How much additional cash does a real estate borrower have after making new promises totaling $500,000 in debt? Well, they might not have any new cash based on taking any new debt. If they get the cash back at close thing, then they have that extra incentive to borrow. But this is a big, I'm hesitant to use the word scam, but a big bubble. It's a big Ponzi scheme. It's a big oddity. It's a historical oddity, what we have now in terms of these assessed values and market prices of things like the U.S. stock market, the U.S. real estate market, UK, Japan. It's a very, very unstable bubble. It's an unstable situation where all these book values of all these companies like AIG and Fannie Mae and so on, they're based on all these market price assessments of real estate and other stocks of other companies. That stuff can change very quickly. I use an analogy on my One-Eyed Kings Wealth Club.com website of if you take 10 experienced mountain climbers and they tie themselves together and go up a mountain, because there's 9 other experienced mountain climbers and they all have a lot of self-interest, each one of them actually benefits and has increased safety from the other 9 being tied to the other 9. If you take a global economy of lots and lots of central banks and insurance companies and financial institutions and so on, and you tie, let's say, 5 million people together and go climb up a mountain together. Well, if you tie 5 million people together, it actually slows down the amount of progress that an individual person can make. They can't really coordinate their, the ones that are experts are just stuck to the other, 5 million people, basically. If there's 5 million and one people and one of them knows what to do and the other 5 million don't want to move, then the one who's tied to them either has to untie themselves from the group or can't move. And if there's 5 million and one people tied together and climbing up a mountain, and 5 million of them are not really good mountain climbers, and 1 or 2 million of them don't plant their feet well and fall off the mountain, what happens to the other few million people? They all go down. So that's an analogy for what can happen with a Ponzi economy, as I call it. If you don't know the term Ponzi, that won't make much sense. But anyway, if you do, great. If you don't, you can look it up. Ponzi. So how much additional tangible book value does a company have if the market pricing of its own assets rises by 100%? If those assets with rising market prices are just inflated real estate mortgage contracts from speculation, or just inflated stock prices from speculation, or inflated prices from promises from insurance companies, there might not be any new tangible value for that company, like in reality. So new promises or new accounts receivable do not in themselves produce new tangible value. New debts do not equal new net profits. New promises do not produce new tangible value. Appreciating assets don't produce a new roof. It's just an appreciation or a rise in price. Right? There's nothing actually produced by that. There's still just a huge, outflow of wealth from places like the UK and US and Japan to places like Saudi Arabia and Libya and so on. Now, Japan overall might have a pretty good trade balance, right? But to certain places, they have a big trade deficit. It's just that overall, Japan, it so happens, has a pretty, relative to the U.S. or something, Japan has a much more steady net trade surplus or deficit. They've had some small deficits in recent years, but even after 21, 22 years of recession, they've actually had a net trade surplus most of those years. So I'm wanting to kind of paint a picture here. We were talking about the old lady with the speed bumps and, thinking positive. Well, I want to be realistic here. There are some issues. There are some big issues. There are some actions to be taken. There are some reassessments. There's actually an immense opportunity present, but there's also some major problems and risks. And people who are thinking, well, somebody put this speed bump in my way, and there shouldn't be a school zone here, and gas prices shouldn't be $3, and gas prices shouldn't be 65 cents in Saudi Arabia. They should be 10 cents like in Venezuela. It's just unjust, and we need to protest, and we need to, well, that's fine. You can think that. You might want to adapt. You might want to reconsider your thought processes and your practices, because your actual practices will dramatically affect your actual results. So call this entire comment, all these audio and the blog, call it negative if you like, but going 50 miles per hour does not remove the speed bump from the road ahead or convert the school zone into an abandoned open highway that you can safely go 50 miles per hour along. If there's a speed bump ahead, slow down. Be aware you're going through a school zone. If there are market volatility or market destabilizing, market shifts ahead, you might want to be aware of that. Look back at the charts. Share this blog with other people. Share the video with other people. Contact me. I will talk to you about what you can do to improve your situation as far as your debts, to improve your investments, a variety of things, to shelter your assets from courts, but still have the full protection of courts. Have the fullest possible protection of courts for your finances, and yet have your assets protected by courts as well as from courts even, or really not from courts necessarily so much as from tax collections and from lawsuits, things like that. Just certain insurance to take that's more practical, like repairing your roof, rather than an insurance policy from a company that may go under. So, don't rely on courts to protect you, but use all the protections that they have, and also don't, consider further protections for your finances and your assets and your revenues and so forth. Alter your investments based on that speed bump and that school zone ahead. It's not going to go away. Going 50 miles an hour just because you were last mile isn't necessarily the thing to do as you approach the speed bump. You're also going to possibly be interested in doing some pretty significant things in regard to whatever debts you have. Again, all of those things I can help you with. Consider that there is an immense opportunity present, but it is not available by presuming first that prices never change, and second, presuming that when prices do change, those changes are totally unpredictable. Price changes are not unpredictable. You can look back at my articles from 2003 or 2004 and so on. Read my predictions. I'll be happy to show you the predictions of many other people who accurately predicted basically all of the major economic changes that may have surprised the vast majority of people from 2005 till 2009 or 10 or whatever, including how governments would respond to those changes. So I do want to stop at this point. Obviously, this is a pretty long overall thing, but feel free to share this with other people. I recommend that you consider contacting me, and actually do contact me, so you can change how you think about what's going on. See the speed bump ahead. Stop driving with your eyes closed. Open up your eyes. Look at the speed bump ahead in global economics. Make some changes that will allow you to travel over that speed bump safely. Maybe even use it as a ramp. That's kind of a joke, but the point is there really is opportunity present. It's just not opportunity present in the actions that were popular and the investments that were popular in the 90s in the US or in the 80s in Japan. Different things work well in this environment and in the coming environment. All right, thank you for your interest. I'm J.R. Fibonacci Hun. This has been negativity about when gas prices will be 65 cents again.